Hey everybody, we're going to talk about financing today. It's a question that we get a lot, and it's really important to understand because financing a new construction duplex, triplex, or fourplex in a master plan community is pretty unique. And what happens a lot of times is investors come to us and say, oh, I already have a bank. That's okay, but kind of not. So we want to talk about that. It's not that we don't want you to have flexibility in your lending options. It's just it's a little more complicated than you think. So here's a quick video on how to think about that. First of all, there are two loans that are going to take place in your garden variety fourplex investment group transaction. There's a construction loan, and then there's a long-term loan, right? Construction loan is you come in, you put 25% down, plus all of your closing costs and a year's worth of construction interest reserve. That's what it takes to actually buy the deal. Now you own the ground, right? That's your construction loan. Just know that the interest rate on those kinds of construction loans is usually 3/4, maybe 1% higher than what you're seeing in the long-term market. Now I want to add something. The long-term market is different than the owner-occupied financing, right? That's the Quicken Loans guy on TV. He's always saying, if your rate's higher than 0.1%, or he's got some insane teaser rate on there, call us. Well, that owner-occupied rate is different than an investor loan. So if you're thinking, oh, I'm going to get the same interest rate on my fourplex as you got on your owner-occupied home, that's not going to happen. That rate's going to be 1/2 to 3/4 of a point higher than your owner-occupied rate. And like I said, it's interest only. And those construction loans are typically issued by local banks, small banks, regional banks, or credit unions. You're not going to go into Wells Fargo and say, I need a fourplex construction loan for a FIG deal. They're not going to know what to do with you. So let me just save you the time. Or even if you've got a private banker over there or something, we've been to that rodeo many times and it hasn't worked. So you've got your construction loan, and then you've got your long-term loan. Now, most lenders can, if they know what they're doing, do a fourplex long-term, 30-year fixed rate loan. We have a preferred lender at FIG that does more of these than anybody in the country, and it's not even close, right? So when we take a pre-approval letter from him to a local bank in Arizona or Utah or Texas, it means something. And that bank would approve you for a construction loan if FIG's preferred lender approved you for the long term, because that's the concern that the bank has. Are they going to get paid off from their construction loan? That's what they want to know. So you could, in theory, come with a letter from any other lender, but then the bank's going to have a bajillion questions, and we've got a schedule here. So short answer, yeah, you got to stick with our financing approvals on the front end to be able to get your construction loan. I want to go to the whiteboard really quick to show you why that's important. So this is a map of Entrada Farms in Idaho. I've been using this map as an example lately. Down here in the bottom right corner, I kind of highlighted it in red, is phase 1. And you see A, B, C, and D, right? It's a duplex and 3 fourplexes in this particular phase. We get a construction lender to be okay with this, and it actually takes about a year of dialogue for them to understand, for this to go all the way up the food chain at a local bank or credit union. But let's say that investor A, B, and C all play ball. They stay with the preferred lender. But investor D doesn't. They say, well, I'm special. I want to use a different construction lender. What we've seen happen before, and the reason we're so rigid on this is, well, A closes on their their duplex, so does B, so does C. But then all of a sudden, this construction lender that we don't know, have no history with, is delayed on D. Maybe they don't close. And guess what that does? Now, investor C can't even start because they're attached to D, whose bank is running behind or not cooperating because we couldn't vet them internally ahead of time. And so not only does C late, and they're grumpy about this, but these buildings, A and B and C, A and B are going to complete. And those owners in those buildings want tenants, wouldn't you? But can they get them? Because D is a disaster. It's a hole in the ground, or it's still being framed. So now, by not going with the preferred lender, it creates a domino effect for us. And this is going to multiply as we get up into the subsequent phases. That's why you got to use our team on the front end of the loan to get pre-approved through our people at First Colony Mortgage. They will then get you a construction loan, which, by the way, they don't make any money by doing that. The reason they're getting you the construction loan is because they want to earn your long-term business. So the question is, can I use my own long-term lender then? Well, that affects us less, right? Because if you're taking forever to refinance your construction loan, that's only your problem. Now, you might be paying penalties if the lender isn't getting it done on time because the construction lender wants to be paid off. So if your long-term lender is dragging their feet or can't get it done, that's your problem. We don't want you to have it. And in addition, if you go outside of our preferred lender network, it makes a lot more work for us because our lender team is here in the office with us. They know when to lock interest rates. They know when to start your long-term applications. They know when to do all these things, how to answer the questions that the appraisers are going to have, and anything else that needs to happen. We always know when someone hasn't used our long-term lender because we get a whole bunch of questions and everybody pulls their hair out, including you. So to try to alleviate that, our builder has an incentive. If you stick with our preferred lender, you get free refrigerators in your units. Question is then, yeah, but can I use my own lender? Sure, we'd rather you not. Go ahead and shop First Colony Mortgage, though. They do volume, right? They're not in this to make big fees. They do a lot of fourplex loans for our clients every year. So I'm pretty confident you're not going to find anybody lower. And I would add two things. If you find a lower rate somewhere, just make sure it's low enough to offset the cost of free refrigerators. And a low interest rate on a loan that never closes doesn't really even matter, does it?